Good morning, folks. Just a little bit of an impromptu live stream here for the London session. Before you get your hopes up, I'm just trying to get myself acclimated to price action from yesterday and today, so that way I can see what I might be interested in. So I'm going to share that process with you today. I know a lot of you ask all the time, like, what do I do at London? How do I use London to build some kind of a narrative bias? Before I get into it, if you follow me on Twitter, just give me a heads up if you can hear me and if my chart's okay, if the stream's coming through okay. Just give me a 5x5 and that'll be good enough for me. Vinay, thank you very much. For those that are wondering, if you can't stay up live, I won't be very long with this, by the way. But if you can't stay, it's okay. It'll be recorded. It'll be on the YouTube channel when I'm done. All right, so let's get rambling. All right, so this is a 15-minute time frame, and this is like my bellwether chart. I like to look at this time frame as a first go-to. I like the ability to see where the liquidity is, the buy-side liquidity above old short-term highs or relative equal highs, or below a single low or relative equal lows, and I like to see the inefficiencies. So I apologize if this right here annoys you, but my live streams, I don't have a way of putting a watermark on them as of yet. So I have to have these unfortunate things here because a lot of people have already taken my stuff and pretended it's them doing it or teaching it. So just, I guess, deal with it. The observation I have here is this single up close candle that is a bearish order block. What makes it a bearish order block is we are in an extreme premium above this short-term high here, and we've moved below it. We have new day opening gap, which will frame, and I apologize, I was a little premature in sharing the chart right before the silver bullet for London session reached into its objectives, which I'll cover in a moment. I actually had the new day opening gap incorrectly plotted. So I like to plot that on like a 1-minute chart. It gives you a better price level. So you'll see a slight difference in that, so that way it's out of the way. I want to make sure that I mention it now, otherwise I may have completely omitted it. This inefficiency right here, inside of this breaker. Okay, so I have half of this, and I'm going to show you what I'm doing here. If you take your fib and drop it on this high to that low, 50% in the upper quadrant, those two levels are of interest to me today. If we lose consequent encroachment, which is the midpoint between this candle's low, this candle's high, half of that is here. So 15,624 even. 15,630 even is the upper quadrant to this inefficiency. So on a discount, that's the level I'm looking at, and it's also framed on the basis of this low, high, lower low, which is a ICT bullish breaker. Below here, sell side. Below here, sell side, and you can note this on your own chart. And then the buy side was relative to this high here, and framed on the context that mean threshold is here. So in a perfect world for London, if it goes above a short-term high, and we have had a really nice run yesterday, a little bit more animated to the upside than I anticipated. Last time I saw the charts before I went and took my son to have his brain scans done after his motorcycle accident, and he's doing very well, thank you. Not completely there yet, but he's improving. Praise God. The high here, right above that high, would be buy side, and it draws right up into the middle of this up close candle. So that's mean threshold. This level here is half of an inefficiency. So it's consequent encroachment, order blocks, breakers, finite order block theory. Midpoints of those levels, or PD arrays, are always referred to as mean threshold. All right, so let's drop down into a 5-minute chart. All right, so right away we can start seeing a little bit more detail here. We have the 15-minute time frame, bearish order block, mean threshold level here, that red level, and then in here we have a balanced price range. Now, I've taught a little bit about this over the course of last year and this year, but a balanced price range is when a market moves from a range where it's offered both sides, buy side and sell side delivery, not liquidity, delivery, meaning that we had this candle here traded up, so it offered buy side delivery, and then we had this candle here offering sell side delivery. So even though this is a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency, it makes it stronger when you have on the opposing side one singular candle up here. So it kind of creates this island reversal type pattern, but we don't see it that way when there's a continuous delivery of price. Whereas if you looked at a separation of candles, for instance, like say this candle, this big large up close green candle, say that it wasn't one singular candle, or that it stopped short here and then the next candle opened up here and there was an actual gap, and then the same thing happened here, it was gapped lower and went down, but a group of candles up here were not connected, if you will, to the previous price run up and the previous or subsequent price drop. We don't see that separation here, but when I see price action like this, the way I internalize it is this is a segment of price action that was placed up here trapping longs or stopping out short holders on this initial run here, and then it moved away aggressively, and then we had the market run right up into the middle of this inefficiency between this candle's low, this candle's high, and if you measure that, see how we had half of that right there? Let me take the other levels off so it makes it a little bit cleaner for you. Half of that inefficiency is here. So 15,681. It wicks through it just a little bit. We call that a mohawk, which is just a small little deviation outside of what would be expected in terms of perfect algorithmic delivery. We'll take this off here. So we have several factors here. We have the market taking buy side there in the afternoon yesterday, inefficiency, consequent encroachment of this inefficiency, which is the 5-minute premium fair value gap. What makes it a very strong fair value gap, the fact that it's inside the context of a balanced price range. It does not mean that I won't take a fair value gap that doesn't have this element in price delivery. It just means that it's a little bit more favorable for me. For instance, let's say that I was interested in taking a trade with the maximum leverage that I'd be willing to take. I would like this fair value gap here with a maximum leverage. For instance, I could build that to 15 to 20 contracts and be comfortable knowing that PD array would offer the framework or context around that level of leverage behind the trade. Versus if I didn't have this and I just had just the fair value gap and an unction and my understanding about what price was likely to do, I may not go higher than 10 contracts short. So it's kind of like helps you frame what I would internalize with the relationship of whether this becomes a balanced price range with the fair value gap or if it's lacking this. Okay, so the difference, so that way you can understand what I'm referring to in contrast. If you were to look at this fair value gap here that I have highlighted, and the fact that we have a previous singular candle delivering on the upside to the left of it, notice that this here doesn't have that same element right there. This is a fair value gap. There's nothing different about this very thing here with this one singular candle going lower. That down closed candle is the same thing that this down closed candle is right there. It's a SIBI, sell side imbalance, buy side inefficiency. The difference or the contrast between this one versus this one is this one doesn't have a balanced price range. This is simply just a fair value gap in the form of a SIBI. So it doesn't have any kind of balanced price range here. It's just simply an inefficiency. And the market does go, in fact, up into it, but look what it does. It consolidates and then tears off higher. So over here is a little bit more context behind why the price should behave like it does over here. So it's not just simply looking at a fair value gap or having software programs or applications, and it's becoming popular, and they're improving, but they're still a little bit limited in their ability to pick the right fair value gaps. There's context, and a lot of those things will be cleared up when I release my book. I don't want to do it in videos, and I know some of you hiss and moan about that, but you usually are the ones that are actually trying to put books out ahead of me with my own content on Amazon. There's dozens of books that's already been written about what I've already taught and authored and things, but they're not correct. So I appreciate your overzealous desire to get it out there, okay, but you're not prepared to do that. You don't know what you're doing yet, so just don't do it. The 5-minute fair value gap here is a premium relative to the fact that we have that 15-minute discount BISI, buy side imbalance, sell side inefficiency, consequent encroachment. Remember, we were on the 15-minute time frame. I was showing you half of that gap inside the breaker. Let me go back up to the 15-minute time frame because I'm sure I lost a few of you. That's this one here, okay? So while we were up here, relative to that price point there and the breaker, which is a discount. So between the breaker and if we go into the breaker a little bit, we have this inefficiency right there. So we can expect, and it would be reasonable, it would be permissible for price action to deliver to this level. Has it done so yet? No, and that's fine. But when we're doing analysis, and when I'm looking at London, I'm looking at these levels and having kind of like parameters and what I would believe are thresholds that if this breaks, okay, then I have to be willing to see if it goes to that level there. This candle's high right there. But I'm only interested if it stays above it, because if it stays above it, I like the idea of this actually going higher later in the day, higher in its scope that we would be higher than this. Or CPI, which is tomorrow, that is a news driver that sometimes can cause a lot of activity the day before. And then most other times, there's days before CPI where it just doesn't do a whole lot. And then there's a face ripping event when CPI number comes out and something extremely volatile and violent. And you don't want to be trading ahead of it because it can roast you real quick. So premium up here, which is middle of this 15-minute candle, which is a bearish order block, and discount. So between those two, that's how we would frame premium to discount. Liquidity was taken here at premium. Sell side here, and then inefficiency with this large bullish breaker. So with that context, let's go back into a 5-minute chart. So we have the balanced price range, premium fair value gap. I just didn't want to put all that here. I was planning on talking about drawing a distinction between that and something like this. So we run up here at 2:50 a.m. right at 3 o'clock, goes to a random 15-minute bearish order block, mean threshold, goes right to it to the tick. Okay, you see that right there? What's the price level right here in red, right over here on the right-hand side on that price axis where it says 15-minute bearish order block, mean threshold? What is that price level? 15,678.5. The 3 o'clock candle, what's the high? You're going to be looking right up here. What's the high of that candle? 15,678.50. Yeah, that's perfect. We have a 5-minute breaker now. So we have the high, low, higher high that digs into the 5-minute premium fair value gap and the 15-minute bearish order block. Now, right away, if this is the first time you've watched anything like this, it's going to seem like this is very confusing. It may be seeming to you that it's an overcomplication. If it's complicated to you, it's because you're just now becoming introduced to it. But I promise you, this is so much easier to understand. It's so much more precise than anything like harmonic or um, anything else out there. Okay, I'm not saying that other folks that trade other ways and other mechanisms that get them into uh, markets one way or the other can't be profitable. I'm not arguing that case. I'm just saying if we're going to talk about price, this is the market. Like, this is what the market actually does. This is how it's coded. It's algorithmically delivered. There's absolutely nothing anyone can say. And I can sit in a courtroom in front of the CFTC, in front of the SEC, in front of whatever you want to do, okay, and walk this out just like this. And whatever they want to call it, what anybody else wants to call it, okay, unless they understand and admit that this is absolutely 100% controlled, rigged, and it's to the tick controlled. It's not buying and selling pressure. These things repeat every single day. Now, there's a variance where manual intervention will step in. It'll step in and it'll influence price. Okay, that manual intervention is man. It's a person. It's a collective. It's someone or something. It's an entity that will want to move price in a otherwise unexpected manner. And that is the underlying risk. That's why when you hear people say, well, if the markets are algorithmic and you understand the algorithm, why aren't you making billions of dollars? First of all, if someone steps out there and starts putting major size down and tries to, you can't put billions of dollars on that one candle, by the way. Okay, that's infancy. It's too myopic of a view. That's somebody that literally just stepped out of high school and wants to pretend they understand the marketplace. Okay, those ideas don't hold water when you understand there's a certain measure of volume that these individual candles are going to reflect. You can't put billions of dollars on that one single touch of that level. So when smart money is attacking liquidity, like above this high here, right above this high, would be buy stops. Anyone that would want to view a run higher than this high, they would be buying on a buy stop. So buying a breakout, which many times in London is a mistake. Or for those that went short from this high or just after it, they're going to put a protective buy stop there. So above this level here is a measure of actual real orders in the form of buy stops, which we call buy side liquidity. So you can see how the market randomly, I say that facetiously, obviously, this high here, they've run that, but it spends a little bit of time up here. What's it waiting for, by the way? What do you think it's waiting for? I mean, it's already traded into the 5-minute premium fair value gap. It's already traded to the mean threshold here. What's it waiting for? Time. When does the price run really begin? 3 a.m. What did I teach you? There is a pattern that repeats that's algorithmically delivered. It runs on a macro. That means it's going to happen every single damn day. It won't miss a day. It won't call in sick. It's going to show up every single day between 3 o'clock and 4 o'clock in the morning, New York local time. That's the London session, silver bullet. It's going to occur in the morning, New York session, between 10 o'clock in the morning and 11 o'clock, New York local time. And it's going to form, I gave you now 2 of them in the afternoon, between 2 o'clock and 3 o'clock and 3 o'clock and 4 o'clock. So you have 2 chances to catch up in the afternoon between 2 o'clock and 4 o'clock. You have 2 chances to find this pattern. And for the London session today, we see the premium. It reaches up into it here. The price run really begins at 3 o'clock. Here's that 3 o'clock candle. What is it going to reach for there? Initially, it's going to reach for the sell side, resting right below here. And I don't want to add more annotations like this one here because it kind of like makes the chart a little bit more cluttered than I like it to be. So this one here is a bearish breaker. So we have high, the low prior to the higher high. That's what we're framing. So I'm showing you that wick there. Why am I showing you the wick? Because look to the left of it. What do you see? What's that right there? What is this? Fair value gap. What kind? Buy side imbalance, sell side inefficiency. So how do you know what kind of fair value gap it is? If it's an up close candle, that means it's a buy side imbalance, sell side inefficiency. If it's a down close candle like over here, it's a SIBI, sell side imbalance, buy side inefficiency. You're going to be anticipating the market wanting to go back down through between this candle's high, that candle's low. But if we have a breaker in there, we want to have this level also annotated, because on this side of the curve, that means the market goes up to take stops to go down. On this side of the curve, but past or to the right of this low, which is a bearish breaker, we have to include this range, extending it forward, because this will act as an inversion fair value gap. So for the folks that are like wrestling with this already, because you want indicators by overbought, oversold, you want moving average crossovers, and I get that, okay, but unfortunately the markets don't use that, and there's no real subtle way of just telling you blindly following indicators or looking for those things. That won't lead to you having a precision oriented approach to reading what price is going to do next, or anticipating it, or forecasting it. And what I try to do is I try to teach you as a student to understand that there are simple dynamics that the market must behave in. There's lines, okay, there's boundaries in which the market's already predetermined. Unless manual intervention. What is manual intervention really? For instance, a unexpected rate announcement, something that comes out where a geopolitical upheaval or a terrorist attack or some kind of wartime event, or September 11th, like we just celebrated the 22 years anniversary of the World Trade Center attacks. Something like that. Nobody really sees it coming, and then the markets have an issue to work out. So it may be that, or it may be something that you won't ever really understand why it took place. It just happens. That is the underlying risk. That is always the case. It's always there when you sign your risk disclosures and you sign up with a real broker and you're having real monetary risk of loss. That is the loss that I am more concerned about, because you don't see those coming. Everything apart from that, I'm okay with if I take a loss. If I do it wrong, I own that responsibility. If I read price action incorrectly, or if I'm trying to be ahead of my own algorithm, when I'm trying to predict before the actual setups are actually there, if I'm forecasting in versus actually reading the market and trading what I'm seeing, that human element, I wrestle with that still. You will always wrestle with that still. Even when you're profitable, even when you're consistent, you'll have these tendencies creep in. But the market itself has elements that it has to abide by. And it has no bearing on an indicator of any kind. It has nothing to do with supply and demand. It doesn't have anything to do with buying and selling pressure. Nothing. It has nothing to do with that. It's absolutely 100% algorithmically delivered. It's running to, unless there's manual intervention, that means the real market makers, okay, not a dealer, not somebody who works at Goldman Sachs, not JP Morgan. Those individuals, they may have a title, okay, they may be called a market maker, but you really are just a dealer. You're not making price. You're not making it. You're dealing within the price delivery that's being offered and piped into you. The aggregate price feeds, you're working within them. You're not creating them. Okay, what I'm talking about is the whole tier way beyond that. It's the highest origination of where price comes from. You aren't going to see that. I can't take you there. I'm showing you how you can see what it's doing why it's doing it, and why I'm precise about what it is I look for most times, not all the time, most times. And you can be wildly profitable if you're correct some of the time with impeccable risk management. Notice I said no Lambo lifestyle. Nobody's getting rich overnight type thing. I'm telling you how to start soberly. But you have to look in price action and see for these patterns, or look for these patterns rather, and see if they resonate with you. If this is too complicated for you, and if you have a way of using other things that may be simplifications for you, and it employs an indicator, and you find profitability in that, and you can sleep at night, don't worry about whatever ICT says. Okay, the bottom line is it's about what you are making money with and not losing very much of. That's all this is about, folks. And if I'm a help in that regard, then wonderful. But if I'm not, tune me out. Stay with whatever you're doing and don't mess with it, because it's very difficult for a human being to wrestle themselves into submission and figure this stuff out, because you're trading against yourself. You're not competing against me. You're not competing against anybody else out there to pretend to be a good guru or a good trader or winning championships or contests that never really existed. All those things are not important. What's important is, are you making money or are you not making money? If you're not making money, figure out how to do that. Once you figure it out, whether it's my material or anything else, it may be something you create on your own. But once you get to that point, don't tinker with it. Don't mess around with it and stay with it. And I'm sure you'll be very content with that. But the problem is that social media invites the opportunity to try to outperform the next guy, or try to be better than this and better than that. And you constantly keep yourself distracted instead of just focusing on making money. So once price trades above this short-term high here, there's buy stops resting right above that, because there's always liquidity above an old high and below an old low. The market's always constantly going up and down for two reasons, only two reasons. It's going up to an inefficiency up here, this down close candle. What happens inside this down close candle? A short-term high forms here. So there's buy side listed right above that. Does it run into that? Gets real close to it, but doesn't take it out, does it? This upper portion of this down close candle, that is the premium range of this inefficiency. If I'm looking at a fair value gap, if I'm looking for a fair value gap that's part of a balanced price range, as I've been outlining here, I don't really want to see it trade to the upper portions of it. I want to see it remain open. Oh my goodness. ICT just taught me how to look for inefficiencies that should not completely fill. Yes, this is one element of it. This shouldn't fill in. If it's going to be bearish, if I'm expecting it to be bearish, if I want to see price run for sell side here, potentially trading into the 15-minute discount, buy side imbalance, sell side inefficiency, consequent encouragement. It's a whole lot of word salad there, but it has to be labeled, right? I mean, you're willing to go watch videos and read books about harmonic animal patterns that have absolutely no reason and rhyme for why the price is going to move. That's mythology is what that is. Okay, that's not real. The market does not care about your camel toe pattern. Okay, it doesn't happen. This upper portion, I want to see that stay open. So the market does in fact trade up to the 15-minute time frame bearish order block mean threshold, which is that red level here, and trades into the lower portion of this 5-minute premium fair value gap. So we're blending a lot of different things here that builds a narrative. It's not just me looking for one fair value gap or one order block. It's a lot of things coming together, coalescing, and then when does it really run? At time of day that the algorithm will start spooling. Spooling is when the price does this type of thing here. It starts running in one direction. This back and forth stuff, that's not price spooling. S-P-O-O-L-I-N-G, spooling. This is not spooling. This is spooling. When it starts running one directional to a inefficiency, meaning like a fair value gap here, or the one that we framed on the 15-minute time frame, the mean threshold, the consequent encroachment of it. If price runs for liquidity or in an inefficiency and it's directional, that's price spooling. If it's doing it in the context of upward delivery or moving higher, okay, that is buy side delivery. That means the price is running higher, offering buy side, drawing to a liquidity of buy side liquidity. If the market is dropping, that is sell side delivery, aiming for and targeting sell side liquidity. Relative equal low here to here, and then we have relative equal lows over here. So when the market breaks below the short-term low here, look at the 5-minute chart here. Let me just move this out just a little bit. Okay, do you see anything inside this 5-minute breaker low? Just the low of this new gap, which we would want to see do what? Stay open. Why would I want to see that stay open? Let's drill down to the lower time frame. Drop down to a 1-minute chart. We'll get a little bit more detail here. Before I do it, there is a 5-minute discount buy side imbalance, sell side inefficiency here. Almost had to go back to this chart. See this inefficiency right here? This is inside of what? That 15-minute buy side imbalance, sell side inefficiency. So in the upper portion of that, above the 50% of it, let me show you here. Watch. 15-minute time frame. This inefficiency right here, from its 50% level to this candle's low, inside that area right there, there is a 5-minute gap right there. That's what I'm framing there, okay? And you can see how the bodies are respecting all that. Now we just recently, right now, traded down into the low of this one right in here, inside of this level here. So this is becoming very interesting for me because I wanted to see it offer some support here. I wanted to see it hit it and reject it. It still could. I mean, this could just be some errant price action. But for the context of a later day premise, I would want to see it not go below this and moving lower. That cancels any interest for me to see this high and or this high later in the day. So it would be a little bit less likely for me to be taking any trades, because I'd rather be going long this morning session or going in the afternoon going long than going short, because this is a lot of messy back and forth price action in here. Not to say it can't do a run below that. I'm just not favoring that right now because this is a lot of balanced price range. It's back and forth delivery. In other words, there's a lot of back and forth, up, down, up, down, up, down. It's going to take a significant price run to get below this low here. Not to say it can't happen. I'm just suggesting right now at the time, looking at the charts live with you here, it's not likely for me to anticipate that right now. Versus if we had just one single run down here and then a complete sharp retracement move higher. That would be something I'd be interested in seeing that get ran out. But because we have all of this in here, it just looks like this is all, and initially looks like it's trying to lure people into thinking it's going to go lower. And I don't subscribe to that yet, okay? But going short during London is fine using the things I'm showing you here. But these levels are framed on this buy side imbalance, sell side efficiency, fair value gap on that candle right there. So that's what these levels are, what it's referring to. Let's drop down into a 1-minute chart. All right, so everything I've mentioned so far is we trade up to the buy side here. This is the high in the 5-minute breaker. So inside of that range, we're seeing this back and forth price delivery. This candle here, this candle here, and then we finally get the run here at 306, drops, trades to the low of the new day opening gap, and here's the high of the new day opening gap. New day opening gap is the difference between where we close at 5 p.m. New York local time, and then we reopen the session trading at 6 p.m. So there's an hour break where there's no trading for index futures, and that is framed. Here, I'll scrub back here and show you where I have the levels noted. This one here and this one here. Those are the two price levels I have. Like I mentioned earlier in the beginning of the stream, in case you just joined, I had this one incorrectly annotated, so just be mindful that has now been rectified here during the live stream. Has no bearing on anything really. It doesn't change anything. It's just I just wanted to be, correct, because I did it incorrectly before posting the chart on Twitter. So inside that 5-minute breaker, why is this a breaker? Because we have a high, the low, and the higher high. This down closed candle right in here is what's being referred to as the bearish breaker for the 1-minute chart, but we're framing it on a 5-minute. And remember, we had that gap, which would act as what? An inversion fair value gap, which is not here in the chart. I want you to do that in your chart, and you'll see how it amplifies what I'm about to show you here. Now, if we're anticipating the likely draw to a discount 5-minute buy side and balance, sell side efficiency fair value gap, that's this levels here I mentioned, or maybe drawing down into that 15-minute time frame discount buy side and balance, sell side efficiency, consequent encroachment, the midpoint of that 15-minute gap. Look at the bodies where they're coalescing at. Look at that right there. Isn't that interesting? And look what price is doing right now. So the market, while up here at 3 o'clock, that candle right there just perfectly touches what I teach you as a bearish order block, which is absolutely not a fucking supply and demand zone. It's not. It has absolutely nothing to do with that. Okay, that's nothing. This level is a specific price level. It's not a zone. It's not something random. I'm not plucking it out of my ass. It's really going to be there in the chart. It's really going to be repeating. The phenomenon repeats itself all the time because it's algorithmically delivered. That means that the markets are absolutely 100% controlled, and you should not be fearful that when I say things like that, and I'm convinced that most people over the years have heard this from me, and it unsettles them. They're like, oh, that means I don't have a chance of winning. No, that's not what that means. If you don't know how the price books, then you absolutely are gambling, and you're probably going to lose your ass. And that's the reality. I don't sugarcoat that. I tell everybody the same way. Unless you know what you're doing, you should never, ever, ever risk real money. And even when you start doing that, you should risk very, very little. And anticipate in the early stages of your development that we will see as new developing students, when we first start trading and we put money at risk, you're going to have and incur losses. And it's going to be a lot in the beginning. So you want to do it where you're taking very little losses and learning from them. Not, well, I got to do maximum leverage and because I got to learn with real money. You don't want to learn that you shouldn't have done that, because that creates fear, and scared money doesn't make money. So inside that 5-minute breaker, which is bearish, the market trades up into that one right there on this up close candle. Okay, what is it doing? Before I say anything more about what, let me zoom in a little bit, because I know you're watching real-time price action. Pay attention to the lesson. What's occurring? I know. It seems like advertising. It's just, I got to keep these jokers honest. Inside of the 5-minute bearish breaker, right here on this candle at 307, what's occurring? The market's trading up into the 5-minute bearish breaker, which is shaded in this shaded area here. It's trading to the low of the inversion fair value gap that you're going to draw from the 5-minute chart. It's not in my chart now. That's the interactive part for you to put in your chart. It trades up to it here, and this down close candle right there. But ICT, look, it has that big wick. I don't give a shit. That wick right there has no bearing on what it is I'm talking about. The down close, I'm sorry, the up close rather. I said that incorrectly, sorry. The up close candle is a bearish order block. So that up close candle, when it's trading to it here, there's two things going on the 1-minute chart right there. Two things are occurring. It's trading to the breaker and inversion fair value gap on the 5-minute time frame. And on the 1-minute chart, it's trading up into a bearish order block. So when you see folks out there saying order blocks are just engulfing candles, that's horseshit too. It's nothing to do with engulfing anything. When the price is in a sell side delivery. Okay, in other words, at 3 o'clock the price starts its run, and the macro begins seeking sell side, which is running here, and then aiming for lower sell side liquidity, which is below old lows or singular low. Every single time the market creates a up close candle in that sell side delivery price run, in other words, you're calling it a trending market. This is not a trending market. This is just a market that's declining. So that's why I don't use those terms, trending, because price swings are not trends. They're not to me. They're price runs. So if I'm expecting and anticipating price running to lower targets into a discount, either for the purposes of going to a fair value gap that's lower than market price, or to a low or relative equal lows for sell side liquidity, either one of those scenarios will provide me the context to anticipate lower prices. While I'm watching price, if I see something like this where we open, we trade down, and we rally up like this, if I'm short, I'm not freaking out over that. I want to see how we see the first up close candle when sell side begins its delivery. Because once we get our price run here at 3 o'clock and we snap below that candle that created it, what kind of candle is that? Is it up close or down close? Up close. So when we break below that, I want to see when price starts to run, we're in an area where I anticipate what's the inversion fair value gap expected to do? Create a resistance factor in price. It should accumulate more shorts. It should offer smart money the opportunity to get in and add, or like you see me many times do, pyramid more short positions in an existing short position. Our next up close candle is this one. Does it respect it? I don't know. What does it do on this one? Does it bump the bottom of it and run lower? The next candle? Yes. But you're looking at this and saying, but see, I got ICT by the balls right here. Here he is. He said that the silver bullet every single day it happens between 3 o'clock and 4 o'clock, between 10 o'clock and 11 o'clock, and 2 o'clock to 3 o'clock, and 3 o'clock to 4 o'clock. There's 4 opportunities for you to quit your fucking job, and you're worrying about everything else in the world about trading and who's doing well on social media. Stop. You're missing these opportunities because you're not focusing. You have to look at this price action in the times I'm telling you to study it, and you will see exactly what I've said is the truth. It's not made up. It's not contrived. It's not mythology. It's not animal patterns. It's not anything but the truth. Because of the framework that is outlined to you here. What time frame is this? What's up here? The 1 minute chart. Okay. What I'm about to show you is going to make some of you uncomfortable because you either don't have access to these types of time frames or you're afraid of them. You think that they're going to do something that would be alien to what would be expected on higher time frames. Some of you would look at a 1 minute chart and say, okay, I trust a 1 minute chart, but I could never trust a 30-minute or a 30-second chart. 30-second chart's just too fast. No, it's not. It's the same price. It's doing the same thing. If you put a 30-second chart, a 5-second chart, a 1-second chart next to an hourly chart, the same market price is being reflected on the hourly candlestick that's going to be shown on a 1-second chart. You just don't know how to read price. When you introduce these elements of understanding where price is likely to go, where else is it, before I get any further, I'm getting a little ahead of myself here, getting rambunctious here. That's the problem with live ICT. I don't have a filter, and I apologize if you're playing me and there's children around, because sometimes I'm going to use terms that I'm not proud of after the fact, but I'm going to say things you probably aren't going to like, and maybe it shouldn't be listened to by your kids. What's this level right here? The new day opening gap high. And this level here. New day opening gap low. This up close candle is in what portion of that range? The premium side of it. In other words, it's from between this this level here and this level here. Split that in half. Right here. So this up close candle is in the premium side of that new day opening gap. If we're bearish, do we want to see it trade back to the premium end of that once we break below halfway, which is here? on this down close candle right there. Once it goes down halfway between new day opening gap high and low, what are we seeing? We're seeing the market break down. We're seeing proof that the algorithm, the thing that actually controls price, and I know some of you don't like to believe it, can't believe it, won't accept it. I don't give a shit. The point is it's going to keep doing it. It's going to do it every week, every day, and it won't stop. And it's better for you to learn how to see these things because it will make your trading better. Whatever it is that you're using, it will make it better. It'll help you ferret out the ones that you're losing your ass on. That's the way it works, folks. You don't have to subscribe to everything I teach. You don't have to do every model, everything that I've ever taught. But how I read price action, that is the market. I'm reading the price of what the market's going to do, right when it should do it, at the time it should do it. And I have reasons to believe it's going to do it. Not, well, let's just hope and pray because the markets are random. Fuck that. If it was really random, I would not be risking money in it. Who would want to do that? Who would want to do that? Oh, you got a 50-50 chance of blowing your brains out. Let's just let's take a chance. What the hell? That doesn't make any sense to me. That makes no sense. But if there's an edge, if there is something that you can exploit that repeats over and over and over again, that to me is an invitation to sit at the table. And all I'm doing is making a place at the table for you for free. All you have to do is investigate and see if what I'm teaching you is really in price. If it's not, you'll know. But if it is, you're going to be floored by it. And everything else is going to look like nonsense. So right in here, in this little area here, we're going to look at these two, well, this little range in here. You can already see there's a highlighted shaded area here. I have that so that way you can see in contrast. You're probably going to hear Piper, which is one of my puppies. She's next to me snoring, so just if she's heard, just know that there's nothing I can do about it. The bumping of the low of that bearish breaker and inversion fair value gap that you'll have on your chart drawn from the 5-minute basis. This little shaded pink area is denoting where on a 30-second chart here's that 5-minute breaker. The market trades lower, and then we're bumping it right there on that candle. Now, right at that candle at 3:07 and 30 seconds, what's actually occurring there? The market leaves that 5-minute breaker, and it bumps into the inversion fair value gap and the 5-minute breaker right on that candle. And more specifically, it's going right into the gap between this candle's low and this candle's high right there. That right there is your London session ICT bearish silver bullet. It's going to fucking be there every day. If you don't know how to read price, if you don't know where it's going to go, if you don't know how to read the tape, this is reading the tape, anticipating where it's going to go. Fucking level 2 data, your order book bullshit, has absolutely no rhyme or reason why price is going to go there. That's spoofing. You can fake all that stuff. You can't fake or spoof the open, high, low, and close of these candles as they're forming. You can't spoof reading actual real-time price action. You can't spoof that. You can do it incorrectly. But once you understand what you're looking for, you're anticipating these things. Once the market's likely to keep going lower, that means you're in sell-side delivery. That means the market's going to go lower to take stops below old lows or reach into an inefficiency below the market price. That means some kind of fair value gap below market price. Where was that at this point right here? All the way down here. Your hair snoring? Hang on here. Let me get this to show the level. Well, I don't think I have it highlighted for that level. Well, we can use the 5-minute fair value gap. So if we were anticipating that level, don't worry, I'll show you what all this is here in a second. But if we're looking for an entry here for the silver bullet, and we're looking for it to trade down into sell side, this red level here is the sell side liquidity pool below the relative equal lows on this level here. That's this red level here. So if we go back into the 30-second chart, and we're trading in this level here, inside the silver bullet, right there. But ICT, I don't have the access to 30-second charts. Get it, because you're going to miss some of the silver bullets if you don't. Okay, because all I'm looking for is that small little separation where there's an actual inefficiency. And I'm going to tell you exactly what's going on right now. At that moment, right in here, as soon as price trades to this candle's high, and as long as the market is above half of this candle's body, which is mean threshold, algorithms, high frequency trading algorithms, are firing in short orders constantly. Boom, 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 as fast as you can get them in there. As fast as the market will absorb it and take them in, high frequency trading algorithms are selling the fuck out of that. And it slows down when it gets to about right there. That selling by the algorithms is not pushing price down. Because if it was, it wouldn't trade up while it was doing it. The market goes up to offer the entity that I collectively refer to as smart money. You're not going to see them. They're not writing books out there. They're not going out there and making courses for you. Okay. In 2010, I went rogue, and you are learning about these things that you would otherwise never even seen, learned, talked about. Nobody's ever done it before. And fair value gaps are not support and resistance on lower time frames. And no, you can't use moving averages. That's all bullshit. That's all bullshit. These are cop-out excuses for people that are selling Mickey Mouse shit that doesn't work. This is the truth behind the marketplace. You've watched me do this live in front of you. You've watched me trade with real accounts, live money. It's reality, folks. You won't believe it until you see it yourself. And once you experience it and you start seeing it repeat, doing back testing, doing what I'm showing you right here, this is back testing. This is my way of back testing, looking for these signatures in price action, collecting the data, and then taking a snapshot of the charts like this in like small little areas over here or over here. You write out your observations and you record as if you anticipated that happening real time. That's positive self-talk. What you're doing is you're creating pseudo experience, which is far better than using something like a market replay report, which is absolutely horseshit. That's not real results. This is where you're going into the chart and you're specifically looking at an element of price delivery and you're internalizing it. You're recording it with an emotional stimuli that at the time when you're doing the back testing, you're talking in the chart like, or the annotations rather, like you really saw it happening. With the pretense that you will go into that journal log entry at the end of the week, at the end of the month, and you reflect, constantly looking at it. And when you read your annotations, your subconscious reads the fact that I saw that, I was happy, I'm satisfied to see price behaving like I expected, and it's filtering out all the negative. The best way to encourage, if you have a child, they're going to want to do well for you when you encourage them. You don't want them to be torn down and break their will by constantly scolding them and saying you're a failure, you're never going to amount to anything. Who would do that? Well, the trader inside of you, unless you are a well-equipped, consistently profitable trader right now, you are a trader in the making. You're an infant. And that's not derogatory. It's just you're not equipped with experience yet. So the safest way to acquire that is through journaling. And it becomes a powerful resource for you to tap into to see these things repeating all the time. It's not something that just repeats once in a while. It's every fucking day. Every day it repeats. It doesn't mean that you're going to be on every day's trade. It just means that you're refining your ability to see these observations in old data, which means that you'll recognize it by repetition in the future, real time, before it actually forms. You'll anticipate. You'll say, okay, I'm going to see how the market behaves at this up close candle because we're likely to go lower. So I want to see up close candles repel price going down. And we're seeing that up close candles are being repelled when they get into them. But this right here, this little inefficiency, that shaded area, let me take this off. That little area between this candle's high, that candle's low, that's the silver bullet. Does price drop like this on your chart? Sure it did. Let's go back up to the 1 minute chart, because once the entry's done, you're probably asking yourself, where would your stop be on this right here? Where would your stop be? It would have to be above this candle's high. Well, that's too much risk. Don't take the trade. Trade with less leverage. You're trying to trade with 15 contracts because your funded account says, oh, you can trade with 15 contracts. That doesn't mean you should do it. All of you should be trading with the least amount of leverage, period. We're in a market condition that is absolutely ripe for a black swan event. That means something that is going to absolutely tear the shit out of everybody's ass, even me if I allow it, which is why I'm not trading with a lot of leverage. I'm not really pushing it right now. There's a lot of stuff going on geopolitically here in the States. I'm going to hold my tongue. I'm going to live stream on YouTube. This is going to turn into a Twitter space real quick. Just know that we have a lot of reasons to be respecting risk right now. And you shouldn't be doing a lot of carnival-like exercises in your trading. Let's go up to a 1 minute chart and wrap this one up because a little bit longer than I wanted to be. But so when price starts its run here on a 1 minute chart, and preferably if you have access to less than 1 minute charts, you should never just have that second chart, whether it be a 30 second, 15 second, 5 second, 10 second, 1 second chart. You should not have that only on your chart or your workspace. You should have a time frame or two above it. In this case, if I was looking at the 30 second chart, I would have the 1 minute and 5 minute chart because it helps you see all the other order flow that would be seen in the candlesticks. Up close candles when you're in sell side delivery should act as real resistance. That's what the algorithm refers to it as. It's an old area where it can be utilized to accumulate new shorts. The algorithm's not accumulating any shorts. It's delivering price for those individuals that participate with that intent purpose to maximize the exploitation of how price is delivered. That's behind the curtain shit. That's the reality of it all. I don't give a shit who says what, how long they've been in the industry, what title they've been given. I don't give a fucking shit. If they have something better than this, they're invited to come over to Twitter, go on a live stream. I will join their fucking live stream and I will run circles around their fucking ass. I don't give a fuck what central bank bullshit you want to come up with. I don't give a shit what brokerage firm, you're a top tier this, you've been this, you're an ex-banker, bring your Mickey Mouse shit here and I will run circles around you. You don't know how to read price. You're going to be looking at something that has absolutely no bearing on why price should go up or down. And that's the facts, period. I've been saying this stuff since I stepped out here since 2010, and nobody has come out with anything more precise than this because they didn't know it. They didn't know it. Goldman Sachs boys don't know this. They're studying my shit now, though. Hello. On a 1 minute chart, after the price starts its run, again, here's that sell side delivery, or sell side liquidity, rather. I'm sorry. Getting a little animated here. I don't need coffee, brother. Chemical imbalances do it for me. Sell side liquidity, relative equal lows, and the silver bullet here. So we're going to anticipate price drawing initial to this one and over here. Here we accelerate to dig into this sell side liquidity pool there. So we create a sell side imbalance, buy side inefficiency, a SIBI. Remember, if it's a fair value gap, if it's a down close candle, that means it's a SIBI. That means we anticipate price at a later time, at some time, it's going to reach back up into it with the expectation that it should offer new opportunities to do what? Accumulate new shorts. If we're bearish, would we want to see this entire range completely repriced too on the upside of it? In other words, overlapped with movement up? No, we don't want to see that. Why? Because if it starts keeping these things open, remember I was teaching you about the 5 minute fair value gap here where it was left open. I would want to see that stay open on above this high here, not completely overlap that candle. The same idea there is what we would expect here. We want to see the upper portion of an inefficiency stay open. So every single time an inefficiency manifests itself in price, and if I'm bearish, I am actively interested in seeing if it stays open. The upper half of it needs to stay open. As long as it's doing that, that gives it lots of room to keep going down. Why? Because it becomes a measuring gap. Breakaway gaps, measuring gaps, and then you can have exhaustion gaps. Now, exhaustion gaps, I've had hit and miss type observations with that. Sometimes I've been really good with anticipating and labeling a exhaustion gap where the price reaches a target and I've been very candid about my weakness as a trader is my exits. I'm never satisfied with my exits. My entries, there ain't a fucking person walking this planet ever, past, present, or future, that will ever be better than my entries. They'll never be that. They'll never be able to beat my entries. But my exits, I am absolutely not satisfied with, because I want the same level of precision and trust that I have for my entries. And you've seen me execute and seen me do pyramiding, and like I'm all over it. I'm in there, like dialed in, like a heat-seeking missile. But because when price runs are going real quick, I had to grow in my, I guess, satisfaction of being content with enough, which is why I teach you all that, because I wrestled, and I still, admittedly, I still wrestle with wanting to be perfect at my exits. Like it's a great goal to strive for and always work towards, but you have to constantly remind yourself that you're probably never going to be perfect. But what's wrong with going after that goal if it's not going to hurt you? As long as you don't let it, bend you up mentally, like I allowed it to do years ago. Like I was convinced, absolutely convinced, that I was going to nail every single turning point every single time. And while I can do it lots of times, I won't get every single one of them, because the human element in me will creep in. I'm bipolar. Sometimes I will have a manic episode. Sometimes I will do something that I shouldn't have done, and then I have to wrestle with that. And I'm thinking about that while I'm trading. So you think I'm an AI. Some of you think I'm not a real person. I'm a real person. I struggle with a mental disorder. I struggle with a lot of things that an average person would do, that has real concerns for family, friends, their own well-being. And there's real money at risk here, folks. If it was just demo, I wouldn't concern myself with any of it. It's just like, there it is. It's easy. But when it's real money behind it, if you do something you didn't want to do, in retrospect, looking back, saying, oh, I wish I would have done that. I wish I wouldn't have traded that many contracts. Or I wish I would have had more contracts on. My mind will gravitate to that. And that's a distraction. Imagine doing all those things and having to keep constantly refer to these time frames I'm using to trade with. So that aspect of this is the complicating factor, not the fact that it is what it is and how it's being taught. That's not complicated. Remember, you're willing to go out and buy all these books from other authors and stuff and try to read how to read price action trend lines, classic chart patterns and whatnot. The willingness that you're willing to subject yourself to that, when you don't know how long it's going to take you to learn that, why won't you apply it to this? Because this is the real shit. This is the real thing here. You may not be able to identify it right now, and it may feel like it's overwhelming to you, but it's the real thing that you're looking for. So this inefficiency, we would want to see the upper half of that stay open. Why? Well, several factors. Number one, it would invite the likelihood of continuation going lower, which we haven't even traded to the sell side here, which is that red level. So the stops or sell stops below that red level haven't even been engaged yet when this was formed there. We have an old low here. So the likelihood of it going up and completely overlapping this one down closed candle and still going lower, I don't like that. So if I was in a trade and I saw this going up to that point there, it would be extremely critical for it to immediately and aggressively reject that and go a lot harder lower. If it was meandering around and not willing to go aggressively lower after going into the high end of this level here, then I would kill the trade. I would collapse it and just be done. Because to hold on to a trade like that in an area where I know the likelihood or probabilities would be shifted against me, then I'm going to start spending mental capital. Even if I have open profits in the trade that have not been realized yet, haven't closed the trade, I'm going to start spending mental capital, meaning I'm going to be worrying and stressing about something that I don't ultimately have any control over. And then I'll start wrestling with the idea, if I get out, it might move in my favor and I'll regret that. If I stay in, it's going to eat up more of my profits. So as soon as you start getting to that point in your trade, are you in control of your trade anymore? No. So you just abandon it, abort it, take your profit, whatever it is, and move to the next opportunity. If it goes against you and would have stopped you out, wonderful, you did the right thing. If it moves in your favor and goes to your target, wonderful. That means your model was correct and you managed yourself correctly. You have to manage you, Nobody's going to do it for you. I'm not going to be in the room tapping you on the shoulder. Hey, you know you shouldn't do that. You have to develop these skill sets on your own. Your broker's not going to say, hey, you sure you want to do that? you sure you want to hold on this trade? Because it's probably not going to fare well to you. It's going to probably go to your stop. You have to be responsible. And a lot of folks, a lot of new guys and gals that come to me, their youth and or their makeup as a person prevents them from being personally responsible. And it's very easy for them to acquire excuses why it doesn't work for them. It's not because it's not rooted in reality or the truth in how markets really book price. It's the fact that you, the operator, are not equipped to do it yet. But you can be if you put the time into it. So if it's not going to go in the upper portion of this gap and trade higher and close it in or reprice to it, we want to see the halfway point or less be sensitive. And here's 25% of this SIBI. I'll show you what that means. From this candle's low to this candle's high, 50% level there, and then 25%. Now, for the folks that want to see my Fibonacci level, here it is again. What I change is this one here. Sometimes if I want to do like a TGIF measurement on the weekly candle to see how far on a Thursday or Friday the market can retrace on a weekly range that's expanded higher or lower. Right now I have it set to 25 because I want to get the quadrant levels. If I want to use the TGIF, I take that off and it's going to be 0.2. So there's the distinction there. In case you've probably seen some discrepancies when I show my Fibonacci settings. These are the ones that are usually changing. Everything else pretty much stays static. So I want to see the quadrant level, lower quadrant or quarter of this range. You can see it here. 0.25 is the measurement from this candle's low to that candle's high. So if I'm bearish, I want to see the market respond aggressively and sell off at either the quarter or the halfway point and not trade up into here. Okay? Because the algorithm, if it does these things like that, that's like a warning sign for smart money to just be careful, don't add new positions. That's what it is, folks. I mean, it sounds like conspiracy theory, sounds like contrived Tom Clancy kind of shit, but that's just the way it is. Okay? It is the way it is. And you tell me, what's the price level here on this high, on that candle? You're going to be looking at it up here, okay? This upper left-hand corner. What's the high of that candle right there? 15,652.75. What's the quarter level? 15,652.75. Find that in your fucking supply and demand, okay? Find that in Wyckoff. Find that in Algo Box. It's not there, okay? All that stuff, folks, all that stuff is nonsense. That's not the real market. That's you trusting a religion of indicators. Some kind of archaic bullshit theology has absolutely no bearing on how price is going to go up or down and why it's going to go there and what time it's going to go there. I know I'm pissing people off and I don't care. Because sometimes you just got to be blunt. So the market goes up into that range. We want to see it stay open. If it closes, then you have to deal with it differently. But every inefficiency, I'm trying to anticipate them staying open. If I'm bearish, I want to see the upper half stay open. If I'm bullish, I want to see the lower half stay open. They may come back down and reprice. If it comes down and reprices, and it hasn't, like for instance, if it hasn't gone below the sell side here, this is important stuff. These are the things that you need to be listening to and why these fucking live streams and videos are beneficial to you. This is the stuff you don't want to hear and see other people complaining, but this is the stuff that's going to make you fucking money. This is going to be the things that helps you keep your money. If this would have repriced to the upper end of that candle's low, if it would have done that, and it did not go below this red level, which is the sell side liquidity pool on the 5-minute chart, that means that I would still be willing to hold the trade, but it needs to start dropping aggressively once it gets there. It cannot wait around and spend time like it was doing here, consolidating, and then goes to the lower quadrant of that sell side and balance buy side efficiency, then dropping. I don't want to see that once it does this, goes back up again. If it would have done that, I would have held the trade, if it would have done that, but it would have been a time stop added to it. That means as soon as it touched this candle's low, it's got 2 fucking minutes to get in my favor and outside of that range here. If it doesn't do it, I'm taking half the trade off or all of it. Because the likelihood is they may not come back down here to take that sell side until New York. Big paradigm shift, what I just gave you there. For the new folks, it's going to feel like it was mumbo jumbo and means nothing. And it's because you're still too new to know what's good information. But that stuff is algorithmic. That is real mechanics behind how you manage a trade, how you manage risk, how do you anticipate and forecast future price delivery, and how you manage yourself psychologically, emotionally. All these things are predetermined protocols. I know exactly what I'm doing, how I'm going to do it, how I'm going to behave. I'm not surprised by price action. I'm not worried about missing a move. None of those things, because this is how I internalize price. These are the benefits of reading and learning what it is I'm teaching you. But you can't just watch this video, this live stream with me live right here in front of everybody live. You can't just watch this one time and walk away with, yeah, I know exactly what he's talking about. You have to go into your charts and build a library of these examples in specific times. How hard is it, folks? Listen, okay, I promise I'm going to continue and be done. But how hard is it for you to simply go into the chart between the time windows I tell you to look at? I can't make it any easier than this. 3 o'clock to 4 o'clock in the morning, London session. If you want to trade, if you're able to trade in that time of day and it fits your life cycle and what you're doing in the world, focus on that. Study between 3 o'clock and 4 o'clock. Is that a whole lot of time to be studying? No, it's 60 minutes. This is going to repeat every day. It's in Forex. It's in futures. It's in commodities. It's in bonds. It's there every day. How many times do you need to see it showing up before you're convinced that it's real? I don't know. But whatever it is, do that many times in backtesting. And then every day, every single day, you do what I'm doing right here. You mark up your charts. You save the data. And you collect it. And you record your observations. It's work. It's absolutely work. But you're building your experience by doing it. You're building your experience in doing this. You can't acquire that experience any other way but by just getting it on your own. Buying courses, joining mentorships, joining discords, buying some kind of subscription-based idea where someone's pointing things out to you. That might be helpful, but you still won't learn how to fucking trade until you start doing this. This is the stage that every single one of my failed students, and I have them, they don't do this part. Every single one of them has not done this enough. If they do this part of it, it will click for them. It will make sense to them. They will find their model. They will find their setup. They will trust what they're looking for is going to repeat in the future. They won't over leverage it because there's no sense of over leveraging trying to get their entire career encapsulated in one trade. That's the secret sauce, folks. This is it. But you don't want to do it because it requires work and you're afraid you might do it wrong. Who's going to tell you did it wrong? You shouldn't be showing your journal entries to anybody. It should be personal. So anyway, if we're anticipating that price run from up here down into, we'll just use the easiest one, which is the sell side liquidity pool here. So from premium to discount, we have a inefficiency here. If we were framing that red line to the mean threshold of the 15-minute bearish order block, if that was the context we were framing for premium to discount, could we take a short in here or add to it? Trick question. I'll give you a second while I get a drink real quick. I'm having a lot of fun this morning. If we take the fib, and for the folks that have been with me for a while, you already know this, my students. Okay, here's the halfway point or equilibrium between that premium to discount range. High, the target, which is this what kind of range is this? It's an implied dealing range. That means it's not been delivered yet. Up from here, we anticipate and we're expecting price to draw to this level here and lower. So that is a implied dealing range. When the market starts booking price and we get this big run here, does this drop or inefficiency, sell side imbalance, buy side inefficiency, does that occur above or below equilibrium of that implied dealing range? Meaning, is it above or below the 50% level? It's below. So while we are willing to observe and anticipate price being sensitive at the 25% to 50% level, we can't take a new position. We can't add to a pyramid position. We can't do that here. This is just an observation level to make sure everything is calibrated in our favor still, and we're just going to ride the trade out. If this inefficiency would have been at or above halfway point, that's where I do my pyramiding. Once we get below the halfway point, the probabilities shift in the manner that I am not willing to assume the risk, because if I start building more positions down here, we've already touched the level, and it could come back to that later on and it could have a deep retracement. And we also have levels like the new day opening gap low that I would have all that new position sitting in drawdown, which would erode into open existing unrealized profits. So when I'm pyramiding, there's a context and a protocol in which I have to adhere to. And if I'm trading within a preconceived idea that we're going lower, I'm not just randomly picking something. I know what range I'm in. And this range is the range that we would use initially. If we are creating inefficiencies in here or order blocks, something like that, I won't use that as a new entry for adding to the existing short position. It has to be in the upper half. It has to be in the premium, which is why I taught that in my core content. Some of you fight kicking and screaming that I'm hiding stuff from you. I'm not hiding anything. I've literally laid it out there on a silver platter, begging you, please, please prove me wrong. And everybody that goes in there trying to prove me wrong ends up making money, ends up passing funded account challenges and gets payouts or trades with a live account and starts making more money than their job. Given enough time, that's the outcome. Not everyone, because some of you are going to tap out because it's going to be too hard. It's going to take too much work, too much time. This is taking longer than I thought. I thought I could do this over the weekend. No. So the price has extreme sensitivity there. So look at the algorithmic delivery there. Okay, 1 quarter level of this sell side imbalance, buy side inefficiency. Is that made up bullshit? I've been preaching this for years. Preaching it for years. This level, okay, this stuff right here, you don't see Chris Laurie talking about that. I'm sorry, I'm going to go there. Chris Laurie is not teaching you this. That's just the facts. The guy he learned it from don't know it either. That level is the exact mean threshold that Chris Laurie won't teach you. This level here is the exact level that only ICT will teach you. And that's not ego. I'm just putting down tent posts, okay, because there's too many people out there saying, and I'm going to remind you all again, there's a $5 million US dollar bounty. Find my stuff in print, in video, anywhere prior to 1996. It will not exist anywhere. Before I spoke it, it didn't exist. $5 million, folks. I'll come to your fucking house and you can live stream it. You will get a bank check. Nobody's doing that because it ain't real. All that's lies. All that stuff is from people that are trying to market something themselves, and they can't stand the fact that I'm out here killing it and creating monsters, and you are all living testimonies that it really works. It makes real money. It's absolutely how the market's book price, and there ain't a fucking thing, not one person that anywhere can do anything about it. Think about that. At 3 o'clock, that perfect high is the very level I teach you as a mean threshold, is the bearish order block. Then the price run begins. The price goes to a very specific price level. Find this in Wyckoff. It's not there. It's not there, folks. That's perfect delivery. You can't improve on that. You can't make it better. The logic behind it, the reasons why price should behave a certain way. How do you trust the trade? Why don't you get scared? How do you know to put your stop where you put your stop loss at? All this stuff. But you can't reasonably and realistically expect to learn what it is I'm willing to teach you in a short little span of time because it's inconvenient for you to do a little bit more work than you thought it was going to take. I'm sorry, but I already told you have to have patience in the beginning. The weak survive here. I said that wrong. The strong survive here. The weak don't survive here. So you're probably asking yourself, what is this negative 2.5 standard deviation level? What is that? Well, this is where the inception of the move began, right here. And the fulcrum point is right there. So you hear my stomach, it's talking to you. I'm hungry. I saw a guy make a post. I got the sound of ICT swallowing saliva in my mind, and I can't sleep now. Well, now you got stomach gurgling, hunger pains, and that's added to the list now. So if we add the Fibonacci level here, here's halfway point, the high, the low, and now I'm going to add the standard deviation projections. Okay, how do you use standard deviations, ICT? Okay, go over to your Fibonacci. Now, here's the part that everybody else out there is not putting in their fucking books correctly. Okay, and then right away, we're going to have a whole new wave of ICT standard deviation projections in new books, little booklets on Amazon. Okay, I promise you, they'll be up here in 30 days. And they'll still be incomplete. The red level down here is the sell side liquidity. Okay, this is a finite level. This is something I know is real. It's going to have a real impact on price. It's going to draw price down there. The market, the algorithm is going to reprice there because there's real orders down there. How many orders does it take? One. What? Yeah. The market's going to go to old highs, old lows, and inefficiencies, whether there's real large amounts of orders or not. That's why I'm trying to tell you, it's not the buying, selling pressure that does this. The market's going to do this like a video game. It's going to go to its boundaries and stop, turn around, and go the other direction until it's met with some other reason to go another direction or consolidate. That's what's going on. It's rigged, okay? It's rigged. It's always been rigged. Before the markets were electronic, men sat around and booked the price themselves. That was it. That's the way they did it, folks. I don't give a fuck who tells you otherwise. That's exactly what it's always been. It's always been that way. And if that scares you, if it unsettles you, if it shakes your whole foundations and belief structure, good. Good. Let it happen. Because it's advantageous for you to accept the fact that this is the way it is. It's an advantage for you to know that it's rigged, and you can go and look for these things that can be exploited. You're going to mess it up sometimes. You're going to over leverage and hurt yourself. You're getting greedy. You're going to anticipate it being there before it's actually there. That's all part of this. That's what makes this hard. That part makes it hard. But the absolute foundation to why prices go up and down and where they stop and where they turn, that's not random, folks. That's absolutely not random. This level here, what I do is I start looking for standard deviations that get at that level or past it. Okay, and I'll show you what I mean by that. If we are looking at this range from here to that low, that is equivalent to one standard deviation. So about this far here would be standard deviation -1. About here would be standard deviation -2. And this would be negative standard deviation 2.5. So meaning that here would be 1. You see it right here. 1.5. 2. Now 2 is good. Why is 2 good? Because it's below where the sell side is. So look at the reaction here. We go to it here, and we consolidate, and then we run one more time. Here's negative standard deviation 2.5 right there. We wick down to the random level of a 5-minute discount buy side and balance sell side efficiency low. Let me show you over here. I'm moving it over so you can read the levels on the annotations. Let me go back to showing you this. So what I'm doing is I'm looking for a convergence of standard deviations and reaching into specific PD arrays. So yes, below this level there's sell side, but it can be overzealous and dig into a deeper discount where that 5-minute fair value gap is. So this is good, but if we use standard deviation 3 down here, Move this over here. I'm not showing you the labels for it. -3 here, which does what? It trades to and just past, which is allowing for what? A mohawk at the 15-minute buy side and balance, sell side efficiency, consequent encroachment level. That's what that orange level is. How we started this live stream today. That would be the best case scenario for me today. And remember, I said I wanted to see how we trade at that level. Look how many times we went to it here, consolidating, 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 wick through it to take out that low, and we're just hanging around. What is it respecting also? Look how the random price action, what did I just do there? Look at the price action around that 5-minute buy side and balance, sell side efficiency. Hammered, hammered, respecting it, the low. See how price is gravitating to these levels here? Folks, that's real support and resistance. When you anticipate that and anticipate how price should behave around it, if the price run has done its run to where I was looking for, remember, we started this whole presentation around the 15-minute discount, buy side and balance, sell side efficiency, halfway point or consequent encroachment. It has delivered every possible scenario that would satisfy me for a London session. Once it does so, all it's going to do is consolidate and work with the levels that's already predefined. I've been jawboning this whole time, and this whole time this market's been respecting the levels I'm showing you here. Do you want to trade short up here and here, hold all the way down to the best case scenario, and likely lose unrealized profits because you're trying to be greedy, versus this is the easiest low-hanging fruit objective, the sell side liquidity. Let me take these levels off here. Let's go back to a 5-minute. You want to sell short here or here at the silver bullet and insist that it goes down to this level here, which is the 15-minute time frame, consequent encroachment of the buy side and balance, sell side efficiency. This here. That you won't be satisfied unless you get all that. Versus this makes the most sense. It's easy, it's obvious, it's so glaringly obvious that the market will likely go down to that level. It's relative equal lows. It would upset anyone that's already long. Using this as a trailed stop loss, for some people, that's fine. It's going to go there. But if it goes here, we want to see it go through it with speed. What? He's talking about when he talks about in the live streams or when I'm doing recorded executions, and I'll annotate live right before the market does it. I'll say, I want to see big candles. I want to see speed and distance. That's going to occur right below that low. I want to see it aggressively accelerate right then and there, proving that it wants to go for this one. So I may not take a partial here. If I'm really confident that it's going to go lower, it'll be a full pull. A full pull is no partial taken. That means I'm in and I'm running the whole show to target. That means I'm absolutely knowing, without a shadow of doubt, I'm on side. I know I'm dialed in and I'm staying with it. No partial getting taken. If I'm in a condition or climate where I could expect volatility to be higher than normal, then I'm going to be more likely to take partials and maybe add them back later on. But most of the time I won't. So the way I mentor you, the way I teach you is to start like that. Be content with, if you were shorting up here or shorted up here, be content with taking a partial below there, because you don't know if it's going to continue lower. You'll learn that over time. But if we see speed and distance like this, then it's very favorable to hold for something like this and maybe even get down into this inefficiency, which is what we clearly seen here. So we went down to that 15-minute time frame consequent encroachment level here, the orange. And all these levels, I I only include these things on the chart and annotate the charts. To me, this is extremely annoying, having these things on my chart. Like I don't have that there, and it doesn't imply that I'm trying to be somehow snooty or snobbish because I don't like to have anything on my chart. Truth be told, it's very distracting for me to do executed recordings and annotate the chart as I go, because I have to think about spelling something correctly, keeping it out of my way, managing it. Did I say it right? Because sometimes in the past I've called a SIBI a BISI, because I'm doing it on a 1 second. I'm usually doing it like on a 1 minute chart, or sometimes on a second chart. And I have to think about what it is I'm trying to do, think about how I want to articulate it to you, type it out, and all at the same time manage the trade. Real money. So it's a whole lot going on, folks. And some of you that are highly critical of me don't really appreciate the level of focus that's required. And that's challenging for me with someone that has the difficulties I have sometimes I'm focusing. But these levels are simply written on a notepad. So when I say I can trade with just a notepad, I don't need to see a live chart. I can look at the ticker tape on the bottom of CNBC. Every 10 minutes, I could look at that and trade off that, because I'm watching time. I'm watching time. I don't need to know what the highest high and the lowest low, the last 1 minute candle, the last 5 minute candle. That's all extra. That just makes it even better for me. But in the beginning of the session, all I need to know is what's the previous high and low. What's the range I'm looking at? Well, that's this candle right here. This candle's low. This candle's high. That's my premium range. Those two levels. I want to see price stay below that after 3 o'clock. And then I want to see how we gravitate to and through this fair value gap right here. If you don't want to see this portion, I'll make it the last thing I say. I'm going to show you this overlay of the inversion fair value gap before I end the stream. That way you can test yourself and see that your chart shows what it is that you should be seeing. But all of these levels here that you're seeing highlighted over here, just in the same order that's listed here, that's what my notepad is. Just those levels. And then what they are, like I'm showing you right here. So it's not like I'm hiding some kind of secret recipe on a notepad. ICT doesn't ever show us his worksheet. Well, I am actually. I'm showing you where it is and where it's derived from on the charts. When I'm pointing out certain things, like the other day I pointed out the levels over here. By the way, I rolled over to December today. So yesterday you saw I took a live trade in NASDAQ. I traded with the September delivery contract for 2023. I'm now following and only focusing on the December contract, so that way you can just discontinue the September contract. So the symbol for this is here, NQZ2023. So if you're looking at ES, it would be ESZ2023. But over here, this sell-off in here, I probably would be better suited transitioning to the September contract, because that's what I was using. So give me a second here. All right, so here's the business on yesterday's trade, what I was working with and what the information was in my charts. All right, so you can see this SIBI here on the 15-minute time frame. This is from Wednesday, September 6th. And this inefficiency from this candle's low If you're enjoying this, if it's been helpful to you, I would greatly appreciate you taking a second to hit the thumbs up. It does encourage me. It doesn't make me any more money. And your thumbs down don't really hurt my feelings, because it's not a big deal. I know it's the same 15 guys from Texas. Sock puppet accounts. The sell side imbalance, buy side inefficiency here, that was what was shaded. And you saw when I shared the result of the trade. I felt that we could drop up into that. So driving up into this would be above all this order flow here. And the only inefficiency above price yesterday was this area in here. So with that in mind, scrub on over here. Here we are. There's yesterday's price action. And if you remember I don't know if I did a live stream or the pre-recorded session, but the last video commentary I did, I told you that I'm not interested in trading until we get outside of this buy side imbalance, sell side inefficiency right in here on the daily chart. Okay, so let me take this off for a second and go to the daily chart, and I'll show you what I'm talking about. Right. Man, I wish I had this coming up as a trader. This is something that would have been very useful to me. This candle's high. This candle's low. So this one big candle right here, that's the buy side imbalance, sell side inefficiency. I said I would not be really all that interested in trading until we get on the outside of the buy side imbalance, sell side inefficiency, meaning it would have to get above this low of that candle or the below this high of that candle. And yesterday we did that. So if we go back into here's that inefficiency, we'll add it back. And here's that buy side imbalance, sell side inefficiency high. In other words, the daily chart, the higher level. So I felt that we were likely to draw back down into that. And I wanted to see, once I got back home from taking my son to get his CAT scans and MRIs, I don't remember if I told you at the beginning of the stream, but we won't know what those results are for the folks that are concerned, and I appreciate that concern, but we won't know until Wednesday. So we're doing a video conference with the doctors, so they're going to review everything then. But I wanted to see after I got home if we went back inside the buy side imbalance, sell side inefficiency, or if we repelled from it. You can see we repelled from it. My concern was, and this is what I shared in I don't remember if I tweeted it or if it was just in Patrick Whelan's live stream, but I know I posted be content with enough and just don't worry about doing anything else. A lot of other folks were wanting to see it can break down more. And as soon as it starts doing this consolidation stuff like this with a higher time frame array like it is here, the daily buy side imbalance, sell side efficiency high, that's a real support factor. And if you start seeing elements of it not wanting to go below that, and it only went below it just to get into the inefficiencies over here. So this area right here in price below that, it makes perfect sense for it to drop down into that because it had to clean up this little inefficiency. Now it's efficiently delivered, and then now you see it aggressively run higher. So I wasn't in front of the charts to be able to see all this stuff or anticipate how it behaved. I would have been all over it right in this decline right there. When we get in lower time frames, I'll tell you why. But below this buy side imbalance, sell side efficiency high on the daily chart, it drops down into this area because this is the only area below this level that needed to be efficiently repriced to. This is one single candle that was moved higher versus something like this. This candle that is right above my cursor, right here, that candle's high in its entire range. Then this candle here, it's moved back and forth between those two price levels. And then we started this candle here and then ran away. And then we had one single delivery of upside or buy side delivery on that one candle, meaning that this went back and forth here, then left it. So this is more efficiently delivered because it spent more time going back and forth in between that shaded area. Whereas this candle only has one individual impulsive price move, and it was directional. It went higher, and it's all one single encapsulation of buy side delivery. One candle movement only. Since it created that candle, until we traded down into it over here, price never overlapped in that range at all. It kept running and running and running and running. This is a deferred rebalance. A fair value gap is a deferred rebalance. It's going to be referred to in a future time It'll reprice back to it at a later time. So it's a deferred redelivery versus a immediate rebalance. Whereas if you have something like this, and say this candle here opened up and traded immediately back down in the same candle after the one impulsive candle like this right here. The next candle, if it opened and traded down to the previous candle's high, if I saw that and I'm bullish, that's what I call my immediate rebalance. That is one of the strongest, absolutely fucking strongest time the market perfectly when you're going to see acceleration, price magnitude to the upside. That will be the very candle or the immediately next candle. So there's the only caveat is if it doesn't run on that one, it's the next one. If it doesn't, here's for your notes for the folks that have had the endurance to stay with this string this long. If it doesn't do it by the next candle after the immediate rebalance, you're going to consolidate or reverse. Is that something that you'll want to hold on to if you're long? No. Capital preservation, folks. That's more important than making money. There's lots of ways to make money, but there's so few ways for people to be able to hone in on how they wreck themselves and then build replacement theology around that. So that way you don't do those things to undo yourself. There has to be protocols for you to be able to know these are times where I would like to see it perform and I'm willing to take large risks. But as soon as I get confirmation it's probably not right for me or I'm offside, I have to kill it and be content with killing it. Abort it. There's no reason for you to hold on to something that's going to be unfavorable for you or likely to be unfavorable. And I'm doing a clinic today. What the fuck? All this stuff in one live stream. Anyway, the price runs up in here, starts getting aggressive. But right in here, I was watching how folks were wanting to see this thing, that live stream. There's a few of them that I listen to, and I like watching their chat window because when their members are chatty and they think, oh yeah, it's definitely going to do this, it's definitely going to do that. I love seeing that as a public sentiment indicator. Okay, it's real people's opinions sharing what they think the market's going to do at that very moment when I'm looking at price. And I'm really trying to measure everyone that live streams and their audience between 9:30 and 10 o'clock. That really helps me frame the bias or a narrative, what I think is going to get most likely delivered in terms of price. So we drew up into this area here on this inefficiency on the hourly chart. Let me show that on the hourly chart real quick. Was it a 5-minute chart? Yeah, 15-minute chart. So here's the inefficiency here. This candle's low, this candle's high. Let me put it back where it goes. That's what messing me up. Which is also why you want to annotate your chart. So you can annotate like this. Okay, so now you know what you're looking at. It's a 15-minute time frame. It's framed on a 15-minute time frame. What kind of inefficiency is it? SIBI. Why is it SIBI? Because it's a down close candle. SIBI is down close. VISI is up close. And then over here, remember those levels I tweeted the other day? Look at that, pretty nice, isn't it? It's probably random. So we traded up into it here at 9:30. So what is 9:30, 10 o'clock? That's amateur hour. Every Tom, Dick, and Harry, every romper room, dollar menu, mentorship guru is going to be pretending they know what's going to happen, and they get sliced and diced and chopped up and or made redundant. The market trades up into that inefficiency here, right above a previous high that was formed at 9 o'clock. So we'll drop down into a 5-minute chart. And again, I'm reviewing yesterday's price action, by the way. So here is what was on the menu for yesterday. The market traded up aggressively to took buy stops here, traded aggressively below this short-term low. This area in here, we'll look at that on a 1 minute chart. I wanted to be able to use this if it was going to offer it to me. It really didn't give me the opportunity to do it, but you'll see it's a fair value gap over here. I want to treat it as an inversion fair value gap, but it didn't give me any opportunity to use it. So I didn't want to take the chart levels off here, knowing that I'd be talking about it today, because I was going to do the review last night, but I just couldn't get myself to sit down in front of the charts. Too many concerns about my son. So after a 4-hour nap, I'm obviously with you all here. But I didn't want to take it off and then you compare and contrast what I shared on yesterday's chart and have somebody say, what were those levels there? Well, what was that all about? I'm going to talk about what it was I was wanting to see and what didn't manifest itself, because if it would have presented it, I would have added to, and it didn't give me anything. So it is what it is. The running up into that inefficiency on the 15-minute time frame, SIBI, and that aggressive run, all of this here was a built-in premium just to take the market right back down to a deep discount, which was that daily buy side and balance, sell side efficiency high. Remember the last commentary I did on I don't know if it was live stream or recorded, but on the YouTube, it was a commentary for what I expect going forward and how I'm going to sit on my hands until we get outside of this imbalance, which was again framed on the daily chart. So here's the low of it, and there's the high of it. So we went up into this inefficiency just to trade back down to that daily buy side and balance, sell side efficiency high. And what's this right here? What are these lows right here? What would be residing below those lows? Sell side. So we have sell side liquidity here, sell stops for people that have been profitable going up. We consolidated, and then we left that consolidation, traded up into a deep premium. Where would be long-term trend following models have their stop loss? Where would they have them? Below these lows. And short-term aggressive traders would have them below that low, that low, that low. You need a book map for that. You need a bubble, something to draw a bubble on a time and price axis. I'm not even sure if it has a time axis on it. It's obvious that's going to be sell stop below these lows. So this is the larger pool of liquidity, and it also is just in the same proximity of that daily buy side and balance, sell side inefficiency high. So it's reasonable to anticipate it to trade back down to that level by in and of itself. But then you have the agreement also that there's relatively equal lows down there, so there's going to be real orders, sell stops below there. So if it is, for the sake of our discussion today, and every time we sit down, if the market is rigged and it goes up to allow people that are in the know, that's all part of the club that you're not a part of. Okay, I'm teaching you how to get in through the back door, but you're not a card-carrying member of that club. That card-carrying member of the club that knows that the market's going up here just to go down, they're waiting for price to get up that really expensive range so they can sell short. But they have to have individuals that are going to be offering them the other side of their trade, which is why they give you this short-term high here. They drop it down. That builds in or engineers liquidity. That's what this is here. So when the market runs up there, what is the narrative? What's occurring here? The market's going up to go down. Is it going to some random level? No, that 15-minute time frame SIBI. If we're bearish, okay, remember what did I teach you this morning so far? If we're bearish and the market's trading up into an inefficiency, meaning this 15-minute time frame, if we're bearish, do we want to see it trade above halfway or consequent encroachment? In other words, let's go back to the 15-minute time frame. I know it's a lot of acrobatics, but it's good medicine. Good exercise. So if we're measuring that, we'll take all the standard deviations off because they're just going to be a distraction. This is the inefficiency, and I'm going to change the color up here to white, okay? That way we can see it pop inside there. Now, looking at that from the context of the 5-minute chart, here's that same 15-minute sell side imbalance, buy side inefficiency. At 9:30, the market rallies up. Where are the bodies stopping? Are they being controlled? Absolutely. It's buying and selling pressure. Everybody that's using everything that's available in terms of retail logic, everybody's coming together with all of the randomness. How many traders are going to trade with supply and demand at that time? How many traders are going to trade with harmonic patterns? How many people are going to be trading Wyckoff? How many people are going to be trading just simply support and resistance? How many people are going to be using GAN, Elliott Wave? All of them are going to be doing something different. And yet you are going to believe the bullshit that people say that the markets are absolutely random and nobody can know what the market's going to do. When I'm telling you that we're looking for lower prices, we can trust that it's going to be lower prices if the bodies, which is what tells you the story, are the bodies respecting this 15-minute buy side? 15-minute city? Yes. Is it wicking into it? Yes. Did it pierce and breach the halfway point here? No. Did it break down below this up close candle right there? Yes. All of this is algorithmic. The bodies are telling you the narrative. Yes, it's bearish. It's really bearish because we can't even go above or even touch the halfway point. Buying in of itself, that's wonderful. When I'm watching price here, I want to see where this candle, when it went up in here, I want to see where that candle closes. Does it stay below and outside of that SIBI on the 15-minute time frame, this shaded area? Yes, it does. So the next one we open up, it rallies up. It should not go above this high, or if it does, it should stop right at that 50%. If it goes above it, the bearish stance that I would have, it needs to be put to the back burner. That means push it aside, or if I'm going to trade, accept defeat and be more willing to take that loss and then wait for more information. With this insight, we drop down into a 1-minute chart. So here we are. And this box here is just simply denoting the opening range gap. So right now it's showing electronic trading hours. Here's regular trading hours. So when I was pointing to this high of that candle. Technically it would be the closing price, but when it's real close like this, I'll just use the high. It's the easiest low-hanging fruit objective. It doesn't need to be perfect for an opening range gap. So up here, when we opened up at 9:30, this run up into that 15-minute SIBI is just building in that false rally, which is dubbed by me as a Judas swing. It leads people astray. It looks like it's going to go higher. It looks bullish. And a lot of live streamers, chat windows were really active saying, we're going up, we're going up, we're going up. And that's beautiful. That's poetry to me when I see when the market's trading at a level I would anticipate weakness or reason for it to start going lower. If I see a lot of chatter in live streamers' chat windows by their viewers, which are the definition of street money, the people that don't know what's going on. And if you do those things, folks, what I'm saying to you, please don't take this as a derogatory remark. I'm not trying to talk down to you. I'm not trying to be mean. I'm not trying to troll you. I'm just measuring your perspective, which is very limited, probably most likely to be incorrect most times. I'm looking at that public sentiment aspect that you provide when you make your unsolicited opinions on the internet. I use that as a resource. That way I can get a real measurement of what the average person that's uninformed, has no ability to read price properly most times, at a time when I'm highly favoring a lower delivery and price. You're getting the perfect scenario of when smart money is going to operate versus when the epitome of retail, the least informed traders, the least likely to succeed. How do I know that? They're in other people's live streams in the chat window talking about what they think is going to happen. They would have their own live stream. They wouldn't be on live streams at all. They would be trading. So I'm not in other people's live streams to learn how to trade. I'm in there exploiting their audience. That's what I'm doing. And you can hate me for that, but I'm being honest and I'm telling you that's what I'm doing. That's the only value that their chat window has. And I'm not learning anybody else's stuff because nobody else is going to be better than me. And that's just the reality. So this is a regular trading hour session chart. And it allows you to denote where the opening range gap is. And the opening range gap is where we closed the previous day at 4:15, which is when the closing bell, it rings at 4 o'clock, and then in the next 15 minutes, then there's settlement. There's electronic trading going on until 5 o'clock. I'm not factoring that. What I'm showing you is the difference between 4:15 and then that of on Friday when we're dealing with Monday. But on any other day, like for instance, if we looked at today's opening, when we open at 9:30, we'll be looking at wherever we closed at the session settlement to where we open at 9:30. But on Mondays, you're going to be looking at where the 4:15 close is on a Friday to where we open on a Monday at 9:30 here. So that big large gap there, that is a real liquidity void. Okay, this over here, this is a fair value gap in the form of a sell side imbalance, buy side inefficiency. This is not a liquidity void. It's not. This is a liquidity void. There is absolutely zero trading going on. That means it's void of any and all liquidity. There was no trades made between those two price points, where we closed on Friday and where we opened on Monday's trading at the opening session at 9:30, opening bell for equities. So it's likely that the market will want to gravitate back down into that. Not always, not perfectly. It may do it a later time, but every time there's an inefficiency like that, you want to have it on your chart. How long? Until it's traded back to. One of your templates, like I have up here, this is just one template, live executions. You want to create one that has new week opening gaps and keep the last 5 weeks or so on there. You can keep them on there longer, just dim them out, but have the last 5 really pop off in a color scheme that would make it more meaningful to you. But every one of your templates, you have a resource available to you with TradingView. And you can create templates where you save them for the purpose of having specific resources and insight. And one of them I would have is the opening range gaps. You don't have to have them on every single chart that you're working with, but there should be a template where you're tracking them. And when they close, you change the color. Right now, at the time when I created the chart before I left the house and took my son to get his medical procedures done, this was the color I opened it up with. If this was completely closed in and it traded all the way down to the low range of it, then I would dim it out, make it something like maybe not that, but something like that. Okay, so that way it's referred to, I can see it and how price respects it, because it ain't going to just close it up and be done and over with. This is a real factor in price delivery. It's algorithmically referred to at a later time. Even if they close, they're useful for a few weeks. They expire after about a month, maybe sometimes a month and a half. There are going to be times you'll find that old gaps 3 months ago will still work. Hint, hint, nudge, nudge. But apart from that and beyond that, I wouldn't be interested in them. So it's important to have a resource or a worksheet, or in this case, a template on your platform like TradingView or whatever else you're using. Opening range gaps are highly impactful to price action. And the levels are the high, upper 75%, 50%, lower quadrant, and the low. Those 4 levels are extremely precise. They're not random. They're not zones, okay? They're very specific price levels. If we're bullish and we were ever to trade back down into this level, say we were higher for a while, and we traded back down into it, I would anticipate the high, the upper quadrant, or the midpoint finding some level of sensitivity. In agreement, but not by itself, with other PD arrays that would be in close convergence to them at the right time of day when we would be trading 3 o'clock to 4 o'clock, 10 o'clock to 11 o'clock, 2 to 3 or 3 to 4 in the afternoon on the PM session. If those levels were revisited and it was also providing another reason to anticipate higher prices or lower prices respective to whatever it is you're anticipating for that time of day for either a silver bullet or model 2022 entry, that's how I would use these opening range gaps like that. And they may be stale or already used and discarded by someone else, which is terrible. That's myopic, and they don't know what they're doing. They will be repeatedly used in the future with an expiration date of about 60 days. But let's change this back because I'm going to keep things as they were. But this is the regular trading hours chart, but we're going to toggle it back to electronic trading, and I'm going to get through this because I'm getting hungry. Just a reminder, if you're having fun, if you're learning, give me a thumbs up. It does really encourage me. It has nothing to do with ego. It just means that I'm tackling certain things that I'm getting appreciation for. So it's not ego. It's like your progress report for me. So here's a low. Here we traded down into that gap there. Okay, so what's the low of that candle? Right there on that 1 minute chart. You're going to be looking up at this price level right here, upper left-hand corner. What's the low of this candle? Right there. 15,414.75. What's the low of this candle right there? 15,414.75. Perfect. Perfect. Not one tick short, not one tick over. It's perfect. I wanted to see it trade up on this candle right there. I wanted to add more right there. This candle's high comes in at 15,413 even. The high on this candle comes in at 15,412.75. I was off by one tick. If it would have given me that one tick, I would have added shorts there. It just didn't give it to me that day. So what I had is what I had, and nothing more could be made of it. The change in the state of delivery, which is an order block. It has nothing to do with engulfing. It has nothing to do with the size of the candle. It has nothing to do with it. It's the fact that we opened or closed higher or lower after a transitional event, like either liquidity has been traded to or an inefficiency has been revisited. We have seen on yesterday's trading, both was the occurrence. We have the 15-minute CIBI, which is that pink shaded area here. We had buy stops taken here. This candle is the uppermost candle, and then the previous candle is part of it because it's consecutive up close candles. This candle's opening price right there, that is the order block. It has fuck all to do with a time and sales data. It has nothing to do with level 2 data, which can be faked. It has nothing to do with order book. It has nothing to do with book map. It has nothing to do with nothing else but that very specific price level right there. That is the order block. What's occurring there? The market has gone up to take the buy stocks. It has traded up into the inefficiency. It's all in a premium. We have a opening range gap down here below. This is all impulsive price delivery, one directional. So it's a Judas swing. It's getting every Tom, Dick, and Harry, retail Rick, all hopped up on goofballs that wants to go long here. They want to chase it. Why? Because it broke out. Everybody makes Forex and futures trading easy. I'm a breakout trader. I do this and I do that. Wonderful. This is how you get your ass handed to you doing breakouts. Okay, you have to know where the likelihood of you being in an extreme and public sentiment, a la Forex Factory, a la other websites I use for futures traders. Live streams are the best because they're chatter, they're window where everybody's talking about it. Or if they're very, very helpful in regards by doing a poll. Like I love Patrick Whelan's live stream when he does a poll. When he thinks, or not when he thinks, but when he gives his audience the opportunity to poll whether they believe it's going to go up or down for the day. I absolutely love that. I wish he would do it every single day. I wish he would do it right at 10 o'clock. Okay. And I wish he would do that every single day because you all could watch this happen. And it's not me trying to say my community is trying to troll his community because I'm indifferent to his methodology. I don't even know what he's doing. And I'm not saying anything about him. I like his character. I think he's entertaining. But his resource for me is his chat window. When they are chatting up their opinion, right when I'm looking at what I'm anticipating in price delivery, if they're diametrically opposed, I absolutely have a 100% strike rate. It's going to happen. It's going to absolutely be perfect. There are sometimes where a few of his members were in alignment with what I was expecting. And that doesn't mean anything to me there. But what I'm looking for is those little sweet spots where not just him, there's other people, like Trades by Matt. I like looking at some of his chat window when they make their opinions known. And there's 3 other people that I'm not going to mention because it's going to sound like I'm beating these people up, and I'm not. I like both Matt and I like Pat. There's nothing against you folks, and if you're part of their members, don't take this live stream as I'm being a dick. I'm not. I'm being very balanced in the way I'm presenting what it is I'm doing. I'm not attacking them personally. I love the fact that they're providing what their opinions are in front of everybody, by hook or by crook. If they do it right, or if they fail, it's in front of everybody, and I have a great deal of respect for that. Another one has entered the fray with me, Top Step. That's a funded account company. I don't have any affiliation with. I won't have an affiliation with, but my son has an account. He's trading through them, and they recently, I don't know when exactly, but they started live streaming. I am interested to see what they think about the markets when they're trading. I want to see what anybody else says in their chat window. So I'll be adding that. So I'm showing you my cards. Like, I'm using that as a resource. That is not an invitation for you to go over there and act uncivilized and stop typing my fucking name in everybody's chat window. It's ignorant. It's ignorant. You're being disrespectful to the person that's presenting their live stream. I'm an audience member. I'm just sitting there just like you. If I say something, it's limited to whatever I say at the time. I'm not trying to draw any attention. I'm not trying to lure people to my fucking channel. I'm not trying to belittle anybody. I'm not trying to troll anybody. I'm not trying to say that their shit doesn't work or make fun of them. I'm trying to be an encouragement, and I just want to be part of the community. That's all I'm trying to be. So if you're taking what this may sound like as adversarial or a means of getting out there and trying to stir up trouble, that's not what was intended. And if you're part of that, you're being a dick. So anyway, it did not give me the entry for a additional short there. So that's one instance where an inversion fair value gap was implied. I had it in my chart. I wanted to see it happen. It just didn't go to that price point, and it was a missed move for an additional short. The market aggressively ran down into the buy side and balance, sell side efficiency daily high with this level here, and then we started meandering around here. And that's about when I was telling everybody that I don't recall if I tweeted it. I don't remember if I tweeted, but I know I did it in Patrick's live stream. I was just basically saying, be content with enough and be safe, because there's a lot of them that were still wanting to go lower, and it just worked that daily buy side and balance, sell side efficiency high, and then right there, see that drop right there into that gap. That's a really nice run up into a premium fair value gap, which is right there. So as a scalper, non-bias, intraday volatility only scalper, with the context that that daily buy side and balance, sell side efficiency high down here, we left it. We had this short-term high taken here. We dropped down, didn't take out that low, ran higher. This gap right there, trading right there, that would have been a nice little long to go up into that level there and then just stop. Don't do anything, because we're inside of the range from this premium to the discount level, which I told you last Friday on live, not live, but on YouTube commentary, that these levels are meaningful to me on the daily chart. So we've already traded to it here. It's respecting and gravitating towards it. And if it's going to run, where were the buy stops that were trailed? If anybody was short here, it's going to be above this high. It didn't go above that high on this one here. It leaves the buy stops intact until it gets there. So if it's going to go to the buy stops here, always think about how it can go beyond that. For what purpose? Inefficiency or another additional closer proximity, higher high. That inefficiency is there. So we're trading up to it there. So this is a nice little bread and butter scalp that could have been done. You might want to journal on that. Look at lower time frames on the 15 and 30 second chart too. There's more information on that. And later in the day, we just ran off, coming all the way up to the top of the 15-minute sell side and balance, buy side and efficiency. But notice, once we got to the halfway point and above it, everything that was bearish or would be considered bearish left the building like Elvis. There's no reason to anticipate lower prices. and we just started working higher. And then using that 15-minute SIBI, look how it's gravitating around those levels. Relative equal lows, what's below that? Sell stops. Wicked below it, consolidated, new day opening gap. What's this white level? Midpoint of that 15-minute SIBI. Consolidating, work around both sides of it. Displacement. These are all times of the day you wouldn't be trading anyway. But I observe all this stuff. When I look at like going into London, I go through all this type of price action and see what they were respecting, what stops that they didn't take, what stops did they take. And this is obviously overnight. And this price looks a little bit sloppier because it's the September contract, not the December contract. But ultimately, it did pretty much the same thing we were outlining on the December contract. So let's go over to NQZ2023. Remember, I showed you we went down, we wicked below that, and we're just working this level. We're done, right? Where are we trading at now? Here, there you go. So it's an understanding of being able to read real-time price action and understanding what it's likely to do and what it's most likely not to do. And there's a balancing act that you have to, there's a lot of things that you have to learn. And I wish there was a way to make it easier and faster for you. I really wish I could do that, because I would. I think you can see it in my willingness to teach you, share, and when I'm available, when I don't have my real life things that come up like anybody else does. I have a family. When these things or illness, something that comes up, I'm prevented from doing what it is I love doing. But if there was an easier way, a faster way, I always pray to God all the time to give me a better way to articulate what it is that He's given me. I don't know how to always do that. So I try my best to do it as best as I can. I'm not trying to hide it from you. I'm not trying to make it harder for you. But these things are going to be learned by you going into the chart and recording them, annotating them, observing them. It's the same thing that you're submitting to if you buy a book. When you buy my books, should you decide to do so, and I'm telling you right now, don't buy them. How's that for a sales tactic? Don't buy my books. Don't buy them. Okay? Don't buy them. If you want to learn how to trade, I've already showed you how to do that here on the YouTube channel. I've already done that. Okay? You don't need to buy my books. You don't need to put more money in my pocket. You don't need to do that. But if you were on the fence about buying it and you're looking for them when they come out, when I get the plaque that has 1 million subscribers that's verified by YouTube, that means that it wasn't done by bots. It wasn't fake subscribers. Once that's verified, and I'll do a little short on YouTube showing here's the 1 million followers, the first book will be released to the publisher and they'll start the process then. That's the way it's going to happen. But the submission to the idea that buying that book or any other book that you've ever bought or read, you made a conscious effort and decision to say, I'm going to give this book my time. I'm going to give it an open mind to see what it will present to me, and I'm going to see if there's any value to it. Any book is just going to give you a static price chart and a paragraph or two, maybe a chapter or two. If you were to think about how much book text, chapters, and volumes of books that I would have filled with all the lecturing and teachings that I've done so far since 2010, where I've been out here vocally from talking about Forex to now predominantly futures, but it's all the same thing. How many books would I have written? Dozens. And you would have submitted yourself to those books. And I'm telling you, in all honesty, they would have been limited in the capacity of being able to bridge your understanding, because watching me do it live, watching me call price before it happens, watching me do real trades with real money, there's no comparison to that. So while it's wonderful that you're excited to see a book by me or anybody else in the future that makes a book and writes a book, they're very, very limited. They're very limited in the scope of conveying and bridging the gaps between what you are hoping to understand and what the intended author's purpose was in delivering that book. I know this is not going to be answered by just a book or books. You need to see me outline it before it happens. You need to see me execute on it. You need to see me show you in great detail. Just in this live stream today, I've been talking to you for several hours. And it doesn't even scratch the surface of what's required of you in your own backtesting and studying. Look at what Price has done when it went down to how we started this video. When we started this live stream, this was the focus point right here on that 15-minute time frame. Right there. What has it done? Traded down to it. Did any of the bodies go below that level? No. What did I say at that time? It could trade down through it. The wicks can go through it. I just want to see does the bodies go below, because I'm more interested in it not going down below it and then trying to trade higher later today. What do you see here? That very thing. That's not random. I'm not pulling shit out of my ass, making it up as I go along. All these things are the protocols that I've taught you in core content lessons in mentorship. I've taught this in individual lessons. I've taught it in live streams over real-time 1-minute charts before they're forming. I'm telling you, this is what it should do. It should not go below here or it should go above the high. It should perform this way. I should be large candles. Like, folks, there's no comparison to that. That's somebody that has experience. That's something that is repeating. That's a phenomenon that you can tap into and make a good deal of money off of it. But if you're reckless with it, if you don't have control over yourself, you can lose money with it like anything else. You can't be impulsive with it. You have to know what you're looking for, why it should be there in the chart, and it needs to be dressed in a manner where it fits your model. If it doesn't, don't push the button. Don't trade it, not even with a demo. Pushing a demo button, even though there's no real monetary risk involved, is creating habits. And you want those habits to be constructive and positive, not bad habits, not rewarding impulsiveness. And then when the 13 different previous trades or trading accounts that you set up as a demo got blown or haven't really shown any results, oh, I'll just reset it. That's the problem with these funded account companies. They're teaching you to think that, well, I can trade with aggressive money management, which isn't really money management, it's just gambling. And I'm going to do the max leverage because even if I fail, it's cheaper for me to do this than to trade with my own money. And I might be able to get a big win over leveraging. That is the absolute asinine way to look at trading. You're trying to make lottery wins. When if you just sit down, simply just sit down and try to do small little incremental gains and then measure how you think. What were your highlights of that? What was the low points? What were you fearful of? What were the things that were paramount in the trade idea? Did it deliver like you were expecting? How much precision was there? How much drawdown did you have? How much time did it take for your trade idea to manifest itself from the time you saw it in the inception of the move to when it got to your target or terminus? How long did it take for that to happen before you got uncomfortable or impatient? Or how long did it take for your impatience to be subsided and then feel confident that you're on side, that you're going to trust the trade? These are all critical measuring points. They're all KPIs to your output. They're measuring values that you have to be conscious of, especially in the beginning. If you don't do that, if you don't do those things, if you don't focus on those aspects of your intellectual thought process, how you emotionally are stimulated by the things that you're thinking and how you're seeing, look at that move here. Right up into this inefficiency again. You're wasting your time if you don't do those things. They're more critical than learning the next thing I'm going to teach you. And I mean that sincerely, because 90% of the problem that you have is you. And you don't want to hear that. It sounds like a cop-out excuse. Oh, your stuff should work with everybody. It will. In everybody's hands. It'll work in everybody's hands if they follow the instructions and allow themselves to get the fuck out of their own way. You're holding yourself back. I'm not. I'm not lazy. You can see I'm not fucking lazy. I'm here more than anybody. And I'm not asking anything of you. No coupon codes are necessary. I'm not selling you shit. But I'm proven. And I'm proving it better than anybody else with any other methodology. Nothing else is going to come close to this. I guarantee you, if they had it, they'd show it to you. And it ain't happening, is it? I'm not trying to be adversarial to anybody. I'm saying put the work in. If you don't think this works, go in, try to prove it wrong. But listen to the instructions. Don't try to paint outside the boundaries I've put out in terms of what you're supposed to do and what you're not supposed to do. If you submit to that and it doesn't work, no, then you found out on your own. Make your observations public. But nobody has done that. Nobody has made a valid attempt, the honest attempt, not some Mickey Mouse shit where they try to do something and scribble a couple pages and say, I took some notes. No, 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 no. Show me your back testing. What have you done? How many months of back testing and logging have you done? What are the details that you recorded? What were the observations that you had? Because that's going to tell you what you're focusing on. And for me, I would be able to pinpoint. And let me hold that back because I'm going to be inviting people thinking that I want you all to send me shit and I got to go through everybody's stuff and and do like a counseling session. Yeah, your problem is this. No, fuck that. I don't have the time for that. Okay, I have 48,000 fucking emails that I can't even open up, and they're just piling in every week. I can't keep up with emails. Don't ask me to evaluate your trading model. Those things that you people tweet to me. Like, can you confirm that I'm doing this right? What's the results? Are you getting favorable results? Because if you're getting favorable results, you're probably on the right track. If you're not, you're probably doing something incorrect. Submit yourself to the process. Submit yourself to the observations of the cause and effect of doing it. It's either going to work or it's not. It's simple. And you're going to know that if you're going to be successful in following this procedure, or if you have the capability of doing it. A lot of people are going to discover that they can't do it because they don't have the discipline. They don't have the makeup in them as a human being to be properly prepared to do this. Not just my stuff, but trading in general, because it's scary. Over here right at this candle, right to the right of it, you don't know what's going to happen, and you want to put money behind that. If you don't know what you're doing, that's a scary thing. And I would admit that would be scary to do that. You wouldn't want to be doing that. I wouldn't want anyone to take that initiative to put risk on something that's completely unknown to them. But knowing how the market should behave, when it should be done moving. We went down to this level here. We've consolidated, and now we're drawing back up. A lot of people would have been looking at other things in here, maybe thinking it's going to go lower. But I'm telling you what I do, how I think when I'm looking at London, or if I wake up. Like, for instance, say I was sleeping and I would be getting up probably like an hour before where you're at now. I would go back through what we've done here, and I don't draw this on the chart, but I'm looking at these points like this in price action, and I'm measuring what did it do? How did it behave? How did it use the afternoon liquidity on Monday? What did it do in Asia? Like, what liquidity did it leave? What liquidity did it take in London? Here's London. We took the buy side. It went up into 5-minute premium fair value gap. All the business we talked about, throughout this entire live stream, and it delivered lower. I don't subscribe to this as, going lower to go retrace and go lower. I'm thinking consolidation to still higher. I would look for that going forward today. For my personal trades, I would look for that. Then that does not mean that I'm telling you that it's going to take this high out. I haven't got to that point yet. I would be looking for things to set up that type of criteria. So I'm open. I'm more willing to take that versus going short below here. I don't want to be short below here. It would be more likely for me to trust being long today. And I'm not suggesting I'm going to actually take any trades. I'm saying that I'm open to the idea that I would like to see higher prices, because I think all of this was just dropping down to pick up more orders to go higher longer term going into the CPI. And what we do for CPI, I don't even know. I have no idea. And I've made my opinions of CPI available real time, before the fact, a few times already. And I think I've only been right twice, which is why I tell you don't try to take a position before CPI. And they can rip your face off. They're very violent moves, real sudden, breakneck speeds. And if you're over leveraged, it could take it away from you real quick. But in proper context also, if I go to daily chart, let's hide everything here and go to the daily. I was talking about the other day, and what day exactly I don't recall, but I know I was suggesting that I favored this candle's high. Like I wanted to see, that was my interest. Like I wanted to see it get down there. Doesn't mean I'm taking a short to trade that level. It doesn't mean that it is me expecting it's going to go there so I can beat my chest and say, see how smart I am. I'm interested in that level. Does it have a willingness to get down there? It didn't, did it? It left that portion open. And we went above this gap right here. So in my mind, I'm wondering, do we need to get up into this portion still? Or do we just bang around between this high and that low, and we'll just have to wait, what we do after CPI? Because CPI is a monster. Like I don't know what it's going to do. No one knows what it's going to do, because it's an invitation to allow manual intervention to step in, just like a rate announcement, like a FOMC event. Those things like non-farm payroll, perfect example too. Your non-farm payroll numbers, the employment numbers, may be positive for the market, but it tanks. That's manual intervention. But they'll later on say, oh yeah, well, the market discounted that news. It was already priced in. But you didn't tell us that stuff before non-farm payroll was released. So they're always going to spin it to make it seem like there was some purpose for why it didn't do or did do something. In trading, we don't have that luxury. If you're trying to make money, you need to be right. You need to know what you're doing is going to be based on something that has probabilities. And if you can't manage that or embrace that uncertainty, no matter what I teach or anybody else teaches, you're not going to be successful. And I try to be very balanced in that regard, because I don't want anybody thinking that I'm trying to sell you a pipe dream and promise you Lambo lifestyle, because that's not what it is here. And I think, what was it? I was going to show you something before I left. Before I close the daily and go down a lower time frame, I want to show you this. The fact that we have traded up, came back down into the imbalance here, left portion of it open, and we're north of this fair value gap. As long as we're above this fair value gap here, draw that on your charts. Okay, as long as we're above that, in my opinion, I'm favoring a run into this wick, consequent encroachment, or high. That's me showing you what I would like to see at this given moment right now. I don't want to see the low that was formed while we were together live streaming. I don't want to see that violated today to the downside. If it does, I'm not interested in trading at all, not long or short. That would completely remove any interest at all. I would only be interested in looking for longs, and there is nothing in the chart for NASDAQ right now to frame that for. So I would have to wait to see what we do at 9:30. The first 30 minutes, that opening range, I want to see amateur hour come in, and whatever they leave intact, whether it be inefficiency above or below or stops, I would have to make my mind up at that time. And if I have that, I'll share it on Twitter. But right now, I'm neutral, but with a slightly bullish bias, if that makes any sense to you. I'm not interested in going short. I'm not interested in selling short at all, neither NASDAQ or ES. So we have this here. I want to go in and put it on the 5-minute chart. This area here, I told you I was going to put that on here. If you don't have it already on your chart to show you the inversion fair value gap, don't look at the rest of this. But this would be an inversion. Hi, Piper. Getting up, shaking her ears. It's time for breakfast, I know. That's mommy's job. I don't do that. Oh, listen to that. The woman has to do very little in life. Feeding the puppies is not asking too much. All right, and that's the inversion fair value gap. It trades up into here. Okay, so that's what I was referring to. Not much in terms of difference between this one here, but it's still nonetheless hitting it. And we're seeing it hit it right there on that candle too. Boom. Where it falls short of that 5-minute breaker. This candle doesn't touch that. This one does touch the no, I'm sorry, I'm reading that wrong. Am I reading it wrong? It looks like it does touch it, doesn't it? Right there. I gotta go back in now. Obsessive compulsive is flaring. This candle's high. Get this out of the way. This candle's high comes in at 665 and a quarter. 665 and a quarter. And the low, I'm sorry, the high of that candle in question, the high comes in at 665 and a quarter. So that's what I mean. It was touching the low of the inversion fair value gap. So again, that's perfect. So, you know, it is what it is. Prior to me teaching you fair value gap theory, and it's still just an introduction at this point still, nobody would have used those levels for lower intraday supported resistance levels. Sorry, that doesn't work like that. And inversion fair value gaps don't work with the logic of using a exponential moving average. Inversion fair value gaps would be opposed to a moving average idea. That's the whole context of inversion. Not inverted fair value gap, inversion. I'm seeing a lot of you say it incorrectly. But that's the business for now. Hopefully I've taught you something, at least gave you something to build your observations on when you go into your charts looking at the New York session, or if you're going into the London. How do you go into your charts looking for specific things? What are you looking for? What factors are you weighing out? How are we using inefficiencies? When should they be expected to completely close in? What levels are we looking at inside of these things? They're not zones, they're very specific price levels, and they're perfectly delivered. That's algorithmic. That's a signature proving that price is absolutely 100% controlled, it's manipulated, and there's no reason for you to be afraid of it. You should be thankful that it's like this. You should be thankful that there's always going to be a new supply of victims that come in that trust overbought, oversold, RSI divergence, MACD crossovers, and exponential golden cross moving averages, supply and demand, Elliott wave, Wyckoff, algo box, horse shit, all those animal patterns, all that dumb stuff. None of that